Over $900 billion in market value vanished in a single day. Major indices plunged. Investors watched their portfolios bleed red across every screen. And now, everyone's asking the same question. If all that money disappeared, who ended up with it? The answer is more unsettling than you think. Nobody got it. It just ceased to exist. In the next few minutes, we'll break down exactly what happened to that money, why trillions can evaporate without a trace, and what it means when the financial system starts erasing wealth on a massive scale. Ever seen those dramatic headlines? Trillions wiped off the stock market. It sounds like a massive heist, right? But if you lost money, and I lost money, who got all that cash? Where did it all go? The answer is both simple and a little weird. It didn't go anywhere. It just vanished. Think about it like this. Imagine you own a house, and your neighbor just sold theirs for $1 million. Based on that, you could say your house is also worth $1 million. You feel pretty rich. But then, the housing market crashes. Your new neighbor sells their identical house for only $600,000. Suddenly, the value of your house has dropped by $400,000. You've lost that money, but it didn't teleport into someone else's bank account. It was never physical cash in the first place. It was just a number, a perceived value that has now changed. The stock market works in a very similar way. The total value of a company on the stock market, its market capitalization, is calculated by multiplying the share price by the number of shares. If a company has 1 million shares and each is worth $100, its market cap is $100 million. If a wave of bad news hits and everyone starts selling, the price might drop to $60. Now the company's market cap is only $60 million. $40 million has been wiped out, but that money wasn't a pile of cash in a vault. It was a reflection of collective confidence and expectation. So when people say money is lost, they're talking about this evaporation of value. It's not a transfer from your pocket to someone else's. It's a decrease in what someone else is willing to pay for what you own. Now, let's get into the nitty-gritty with a more tangible example. Let's talk about baked beans. Imagine a small, isolated town where the only thing people trade is cans of baked beans. There are 1,000 cans in total. Initially, everyone agrees that one can is worth $1. So the total value of the baked bean market is $1,000. You own 100 cans, so your baked bean portfolio is worth $100. One day, a rumor spreads that a new super delicious brand of beans is coming to town. Everyone panics, thinking their current beans will become worthless. They rush to sell. To get rid of your cans, you have to lower your price. You sell a can for 90 cents. Then someone else sells for 80. Soon, the price plummets to just 10 cents a can. Now, the total value of the entire baked bean market is only $100, 1,000 cans at 10 cents each. The market has lost $900. Your own portfolio, which was worth $100, is now only worth $10. You've lost $90. But where did that $90 go? Nowhere. It just evaporated because the perceived value of your beans collapsed. The only people who made money are those who sold their cans at a higher price before the crash and bought them back at the bottom. They didn't steal your money. They just timed the market better, selling when confidence was high and buying when it was low. This is exactly what happens in a real stock market crash, just on a scale with way more zeros. It's not about money moving, but about value disappearing. Panic is the fuel for this fire. When a few influential investors start selling, others get scared and follow suit. This is called panic selling, and it creates a downward spiral. More sellers than buyers means prices have to drop to find a new equilibrium. This creates a feedback loop. Falling prices cause more panic, which causes more selling, which causes prices to fall even further. What really kicks this off? Sometimes it's a specific event, like a banking crisis or a global pandemic. Other times it's a change in economic policy. For example, if a central bank suddenly raises interest rates to fight inflation, borrowing money becomes more expensive. This can slow down the economy, reduce corporate profits, and make investors nervous. They start selling stocks, anticipating a downturn, and their actions can actually create the very downturn they feared. The impact of this isn't just numbers on a screen. This loss of paper wealth has very real-world consequences. First and foremost, it hits investors. People's retirement funds, their savings for a house, or their children's education can shrink dramatically overnight. Imagine saving for 30 years only to see a third of your nest egg vanish in a week. It's devastating. This leads to the next major problem: a loss of consumer confidence. When people see their investments plummet and hear news about economic doom and gloom, they get scared. They stop spending money on big-ticket items like cars, vacations, or home renovations. They start saving more and spending less. When millions of people do this at once, it creates a massive drag on the economy. Businesses see their sales drop, so they cut back on hiring or even lay off employees. This, in turn, creates more economic fear, and the cycle continues. Because our global economy is so interconnected, a crash in one major market, like Wall Street, can trigger a domino effect across the world. If American consumers stop buying goods, it hurts manufacturers in China and Germany. If American banks are in trouble, it can affect financial institutions in London and Tokyo that do business with them. This global interdependence means that instability can spread like a virus, turning a local problem into a global crisis. This is usually when governments and central banks step in. They have tools to try and stabilize the ship. They might cut interest rates to make borrowing cheaper and encourage spending. They might inject money directly into the financial system to make sure banks have enough cash to operate, a process known as quantitative easing. In extreme cases, they might even bail out critical companies or industries to prevent a total collapse. These interventions are designed to restore confidence. The goal is to signal to everyone that the situation is under control and to stop the panic. By calming the markets, they hope to get consumers and businesses spending again, kickstarting the path to recovery. So, to wrap it all up, when trillions disappear from the stock market, the money doesn't go anywhere. It's a loss of value, a collective change in perception driven by fear and uncertainty. This isn't just a problem for Wall Street traders. It affects everyone. It shrinks our savings, spooks consumers into hiding their wallets, and can send shockwaves through the entire global economy. It's a powerful reminder that much of the financial world is built on a very human foundation: confidence. And when that foundation cracks, the entire structure can start to wobble. Understanding this helps demystify those scary headlines. It's not about a magical money-sucking monster. It's about the psychology of the crowd. And that's a lesson worth more than any stock tip. Thanks so much for watching. If you found this breakdown helpful, please hit that like button and consider subscribing for more deep dives into how the economy really works. See you in the next video.